Okay, so welcome to BA300 Finance. I'm going to give a brief introduction for myself, walk through some basics in the syllabus. But before I get started, I just want to make sure I understand and know everybody that's in the room. So, Toma Frost, Amanda, Richard, Eugene, and that leaves Maria. Okay, so I'm Ed, and a little bit of my background, I'm the Chief Financial Officer and General Counsel at St. Martin's. So my normal day job really is running the university's finance, accounting, facilities, human resources, legal departments, among other things. I'm also an assistant professor of business in the business school. I try and teach about 3 classes a year, normally a couple in the spring, 1 in the summer. The fall for us is actually, the university is on a June 30 fiscal year, so my late summer, early fall are really busy. So this is when I get to come back in and teach. I've got 20 years of finance and accounting experience, most of it in turnaround situations, and most of it in kind of financial services. And we'll talk a little bit about that as we go through. I like to tell stories. I started my career, I was an ROTC cadet. That's how I paid for college. So I started my career in the Army, got out after 10 years, most of it in the National Guard and Reserve. And it's been, my last weekend drill was September 9th, 2001. So timing is everything. So I've missed all the deployments. I've got a bachelor's in finance from Notre Dame, an MBA from Syracuse, mostly in operations management. And then I've got a law degree, and my focus on the legal side and kind of working through much of my career is on bankruptcy, insolvency, and turnaround situations. That's not why I'm at St. Martin's. I came to St. Martin's to try and get away from bankruptcy, turnaround, and other situations. If you need to get a hold of me, I'm on the Lacey campus. Best way to get a hold of me is by email, and because I'm in meetings a lot of the time. That should be 360-438-4534. That's my desk line. And generally, if you call, you'll likely get Emily. Emily's the administrative assistant for the dean of students, myself, the marketing department. And so if I'm not there, she'll take a message. I'll get right back to you. And I hold office hours 8:30 to 10 on Tuesday mornings. So if you're down in Lacey and want to swing by, let me know. The other thing is, for this class, we have precious few classes because it's Monday. And so we already didn't have class last week because of MLK Day. We've got Washington's birthday or President's Day. We don't have class. We've got like 6 classes. So it's precious. There's precious few classes. And I'm going to talk a little bit about how I'm going to try and teach this a little different than I had taught last year when I had 2 classes a week for 8 weeks, so 16 classes. But if you have problems or questions, I'll stick around after this class and happily kind of work with you. If you know you're going to have problems, let me know. Try and get up here a little bit early, and we could sit down before class. You can come in on Tuesday, and if you need to have a separate sit down, I can come up here on Wednesday night as well and kind of sit down with y'all. Finance, the class in and of itself, is a relatively comprehensive course. So how many of y'all have taken a gander at the book, the syllabus, and the online stuff? Okay. I'm going to give you some heads up. Any questions thus far before I kind of dive into this stuff? Okay. We're going to use Moodle. We're going to use email. We're going to use the online portal. The online stuff is pretty critical for this class. As a matter of fact, you can't pass it without it. I tried to get the most inexpensive finance textbook I could find that covers the basics. So that's this CFIN 5 textbook that we all have. There's a couple challenges with it. So I've had other classes. That's this beautiful one right here. If you don't like hard copy, you can get the ebook as long as you get the online access, because the online access is going to be critical for the class. The book is okay. It's going to give you enough, and that's about it. If you've got additional questions and the book's not deep enough, you can normally Google the information you're going to need, or you can get it on YouTube videos or the videos that I posted both on Moodle from last year's classes where we did go through more of a lecture format, or other classes that are out there on YouTube or other online resources, as opposed to buying a $300 textbook, which is the alternative. So there's better books out there, but this one is good enough. And if you need more information, kind of dig into the internet resources that are available, ask a question. But I'd rather, since we all have to pay for books, I'd rather spend less on the books and more on other things. So we're going to use those methodologies to communicate. So if you are having trouble logging on to the site, we'll kind of walk through it tonight. I'll show you how everything works. But if you're having trouble logging into the site, you don't have a book, you're going to need to get those things resolved pretty quick, and we can again walk through that together, either after class or before class next week. Any questions on the book? Okay, I'm going to walk through the syllabus briefly because we're covering an awful lot as I mentioned, in a very short period of time. This class is almost impossible to cover in an 8-week section with 2 classes a week for 3 hours. So for those of you who might have had folks who had me last year, they'll tell you it was like a fire hose. It's, there's a lot coming at you. Having 6 classes is going to be even more difficult. I'm going to commit to you, every one of you in this room, if you put forth a modicum of effort, will pass the class. So don't take the, oh crap, I can't pass, this is going to be impossible. We're not going to get there. We're going to go with a cooperate and graduate type of approach in this class. I want to make sure you understand the concepts. I want to make sure you understand kind of the math behind everything, but really be able to communicate and think about problems, business problems that include a kind of financial perspective. So I don't want you to panic because it's going to feel overwhelming, particularly when you start getting into the assignments. And I don't want you to go into panic mode. It's a hard class. It's kind of like quant methods. There's a lot of stuff there, and it's very difficult, at least from my perspective, to do it in 8 weeks. It's even more difficult to do it in a blended format where we're only seeing each other face to face 6 times, of which 1 time is tonight, where I'm kind of blabbing at you about what we're doing. So we're going to try an approach, and I sent it to you in the email earlier over the break. It's called a flipped classroom, and I'll talk about that kind of as we go through the syllabus. But a flipped classroom concept is really one where I'm not going to stand up here and lecture. What I really want to do is you guys have a ton of assignments that are going to be due basically every week, every Friday. And I want to be able to then take the following class and go through anything that you've got where you've got questions, where we've got concerns, where you're like, holy crap, I couldn't figure this out. We'll walk through that together. We may work in some small groups. So I may go, okay, you 3 work together, you 2 work together. Let's try and work through some of these problems to make sure you understand. So more of the lecture piece is going to be on your own. That's why there's the YouTube videos are up there from last year. And I'm recording now, and we'll continue to record these in-class sessions. And really, I want these to be more, let's go back and forth. Let's take a look at what's going on. Let's take a look at your homework. Let's take a look where you're having problems and questions. Let's work through some of that together. Let's work through the Excel piece together, because Excel is a critical component to this class. Let's make sure you understand that here rather than have me stand up here for 3 hours and lecture out of the book. Everybody good with that? All right. So the book is, we're going to use it as best we can, as much we can. Coming into here, you should have had accounting 101 or 201 and 202. If you don't have the accounting, it's probably not going to be too far over your head. So if you got waived out of a prereq or you haven't had it since for 10 years because you took it at junior college, and now you're taking this. It's not going to be so horribly difficult that you can't get your mind around the accounting concepts. The math, the hardest math we're going to do in here is algebra and exponents. So you're not going to get you're not going to get calculus. You're not going to get, if I don't have any finance majors in here, do I? Okay. You're a finance major? You get calculus later. Once you get into the rate of change and stuff like that in the finance electives, and I'll try and gear the course to anybody accounting. So you guys are all management and marketing except one finance. Okay. So I'm going to try and gear it to how a management or marketing person would utilize the material in the course. So I'm not going to kind of teach it for finance majors. I'll let you kind of know where there's areas that you should probably emphasize further as you go forward. But really, I'm going to try and focus it on showing you why this matters. And so as a result, we're not going to memorize formulas in here. All tests are open book, open notes, open internet, open computer, open any resource you've got. I don't want this to be memorization. I want it to be concept understanding. So again, we're going to develop an understanding of basic proficiency. It's not memorization. Class attendance and course expectations. So I record every class, or try to. It's going now. It's up on Google Hangouts. I'll post it up to Moodle. I post it to my YouTube channel. You guys can go back and look at it anytime you want. If life happens and you can't make class, you can log in, watch it on Google Hangouts, or you can watch the recording. However, attendance matters, especially when there's only 6 classes, effectively. So I'm going to take attendance, and being here at class is important. We have one member of our class who's already now kind of ETS'd and is sitting in Hawaii. She's going to be taking it fully online. And may pop in or out the Hangout, which is cool. But for the rest of y'all, I kind of hope that you're here each Monday that we've got class. So class attendance and participation is going to be 15% of the grade. The online assignments, and we'll walk through the online assignments, are going to be 25% of the grade. The midterm, which is a take-home midterm, and it's at your own pace, at your own leisure, with a hard deadline, open book, open notes, open everything, is 30%. And then the final is 30%. So kind of taking a step back, if you are the type of person that are like, I freaking hate final exams, they stress me out, I get test anxiety, you can pass the class and not take the final if you show up to class, do the assignments, and do the midterm. And for the online assignments, you could take them as many times as you want. They're quizzes. You can take them as many times as you want, and I'll take the highest grade. For the midterm, you can take it twice, and I'll take the highest grade. So you've got a chance to continue to increase your grade as you go. I can guarantee to you that the final exam is going to feel like a bit overwhelming. And I'm trying to adjust it based upon some feedback I got from the last couple classes. Having said that, when you get it, don't stress. Work through it as best you can. I also curve the final exam. So everyone in here, if you show up to class, you do the online assignments, and you take the final, you'll pass the class. So I want to take the stress of, oh my God, I'm not going to pass out. Not going to pass out of the class, because there's so much going to come at you, it's going to get stressful. This is one of those courses, it's one of those survey courses where we cover a ton of stuff, and we're asked to cover a ton of stuff in a very short period of time and with a limited number of in-person classes. So it's going to feel very difficult to get your hands around it. And going into finance as a major, I'm guessing this is your first finance class you've taken. Okay. Going into finance as a major, there's going to be sections in here where I'll tell you it's a critical concept. You really need to understand this stuff. It's important for everybody. those things that I talk about for critical concept, dig in. And if you have any questions, come see me. And let's make sure you've got a good base before you move forward, because if we don't get a good base for you in this class, we're not giving you the right service. And for the other, the other 5 folks that are in here, 4 plus 1, I want to make sure you've got a good general understanding of how finance works. But I'm not as worried about okay, I can do problem after problem after problem after problem. We use the standard university. Here's the standard university grading scale. So a 70 is a C minus, and if you add up, you take the final out, you give yourself a 0, you'll get a 70. So you get a C minus in the class, provided you kind of do all the others and take your time, do open book, do them well. Any questions on that piece before I dive into the classes? Okay. Let's talk through the schedule. So class 1 is tonight, introductions, review syllabus. I'm going to walk you through the online assignments. Hopefully you've had a chance to look at the book and kind of take a dive a little bit into chapters 1 through 4. I'm going to cover some concepts out of chapter 1 through 4. It's going to really be the only class you've got that is going to feel like a lecture. The rest of them, we're going to be using the split methodology because you got the quizzes due next week. And we're going to try and focus on some of the key concepts in managerial finance that are going to underpin everything you guys do from now through the end of the quarter. Class 2 is the 29th, next week. We're going to talk chapters 5 through 8, which is valuation of financial assets. And we're going to first spend the first part of next class covering any questions you guys have from chapters 1 through 4, which is key concepts. And you'll see that we kind of broke the class up to match how the book is grouped. So if you look at the book, you'll see this. There's part 1, introduction to managerial finance, and then 2, essential concepts in managerial finance. That's chapters 1 through 4. So each class basically has one of these big chunky components to it. The next class, or the next one, is part 3, valuation of financial assets. We're going to cover methodologies for that next week. Once we answer and go through any questions that you guys have from chapters 1 through 4. And this is going to be the pattern we follow. We're going to make sure that if there's questions or issues or concerns that are coming up out of the quizzes, or coming up out of the readings, and you go, hey, let's cover that off, we're going to do that first. To the extent we have time, then we're going to cover the material from the next chunk of the book, and I'm going to try and pull out those critical concepts that I've found for me and for others to be most difficult. We'll cover those in class, both in terms of lecture and then maybe do some practice work in small groups, so you guys kind of get a feel for working the problems and using Excel and kind of getting all that nailed down. And then that'll be the end of that class, and then we'll roll forward. Class 3 is 5 Feb, and that's capital budgeting. So I'll cover on these pretty quickly. Valuation of financial assets are things like stocks and bonds and how you value those types of assets, CDs, other things. Capital budgeting is given 2 choices. Which choice do I choose given limited resources? The next class, 12 Feb, is going to be cost of capital. So if you think about finance, it kind of boils down to 2 fundamental things. How do I use my money, and how much is it going to cost me to use my money? So how do I make money-based decisions? So we're going to talk about the cost of money. We're going to talk about the choices between 2 different projects. Then there's no class on 19 Feb. Midterm is due, and the midterm covers chapters 1 through 10. And that's done online using the online system, the Cengage system. It's multiple choice. The quizzes are all multiple choice. They're on the system. They're all open right now, so you can take all the quizzes tomorrow if you wanted. Take them as many times as you want. But there'll be no class for this one, but in lieu of class, because that's President's Day. But in lieu of class, it's sit down, make sure you've got that midterm done. The fifth class that we've got is discussing everything from the midterm. So any issues or problems, and I'll take a look at where everybody's scores are and go, okay, here's some areas that we probably need to make sure we cover off. Then practical applications of finance within a company. So we'll walk through some cases, make sure you understand how this all works together. And then we'll have the final quiz due March, comprehensive, final, plus a quiz due. And again, the final for this class tends to be, folks have viewed it as relatively difficult. I'm going to describe what it is now so that you have a perspective of what we're building to. You're going to get, probably right here, an annual report from a company. Last time we used PACCAR, which is a company headquartered in Bellevue that builds trucks. And I hand everybody an annual report of a public company and say, okay, get familiar with where everything is on here because I'm going to ask some questions on the final exam. For the final, I hand you a list of questions. What's their average cost of capital? What's their effective tax rate? What's their working capital? What's this ratio? What's this ratio? What's this ratio? How's it changed over time? Who's their auditors? So we basically walk through taking the publicly available information from the PACCAR annual report and you do some basic financial analysis around it and apply everything that we learned from here to something you might do if you're going to work for them, for instance. If you were in sales and you're going, okay, I want to extend credit to these folks, and this is my recommendation to extend credit. If you were looking at, are they in a position to buy? Are they not in a position to buy a certain product? And then you also, again, have a project where they'll go, given PACCAR's cost of capital, should they buy or lease something? Should they do this project or that project? That's what the final will look like. It's, yes, ma'am.
Is it overwhelming for other students because that's not multiple choice and everything up until that point is multiple, or is it multiple choice?
No, it's not multiple choice. Okay. It is a pounded out, and generally the way that they've approached it is I've said, put your answers here, do the work in Excel, email me the Excel spreadsheet, and then give me the answers to each of the problems on the piece of paper. If you can't figure it out, at least show me what formulas or what functions in Excel you would be using. And most folks got, I think the lowest grade I gave on it was a C, and they ranged up to an A++, because once I applied the curve to it, it ended up, somebody got 102 because there was extra credit, and then they ended up with the curve at like 122. So it's overwhelming more because there's a list of questions. It's going to be difficult to get through them all, and unless you know kind of everything down cold. So I'm working on now kind of tailoring that back, because what I don't like is having everyone go in, tears and holy crap, I can't finish this and that kind of stuff. So I'm working on the final, but I'm also going to give a heads up that it may, and it is not multiple choice. It isn't taken as many times as you can, but the intention, when you look at the multiple choice questions, you really need to do the work to get to the multiple choice answer. And it's not going to be any more difficult than those multiple choice questions. Any other questions on these 6 classes? As noted, one's a final, one's tonight. So there's really 4 hardcore classes where we're reviewing materials. So coming into those classes, and I think I sent this in the email, I need you to be prepared with, here's stuff that's bothering me. Here's questions that I've got. Here's a problem that I had an issue with on the quiz. And, here's the problem. Can we walk through this together? The first part of every class up until we're done, and the most important part is really walking through okay, this isn't clicking for me. Can we walk through this problem together? Can we walk, because I'll throw it up here on the screen. We'll walk through the Excel together. We'll walk through the math together. We'll walk through the logicking out the problems. But I want to make sure that that's first. So be well prepared coming into the class with, here's where I'm having problems and here's where I need your help, because everybody else is going to be similarly situated, especially when we start getting into some of the math stuff. Because again, it comes at you like a fire hose. There's a couple opportunities for extra credit, and they're writing oriented and short. You can do one or both, your call. So financial analysis of a publicly traded company using the methods learned in chapter 2. We're going to talk through that tonight. No longer than 2 or 3 pages, inclusive of any spreadsheets, and they should be emailed to me. So you can pick any publicly traded company, do a basic financial analysis, tell me what it looks like. We're going to talk through that storytelling today, and then email it to me. The second is review any article from The Economist or a similar periodical. Provide an analysis related to the information contained in the article with the concepts in the course. Minimum of 1 and no longer than 2 pages. And these will both result in additions to the final exam after the curve. So it's a good opportunity to kind of plus yourself up. So if you do have test challenges, you can figure that you get 15 points on the final if you just do the 2 extra credits, and that's a total of 5 pages of writing. It also helps synthesize the information for you. So they're there for you if you want them, but they're certainly not mandatory. Any questions on the syllabus? So like I mentioned, it's kind of a cooperate and graduate class. You guys can work together on pretty much everything except the midterm and the final. I want you all and all of us really use Moodle as much as you can. There's kind of ask the question, send the email. There's the sections in there where you can post out, here's a thread and a topic. Go ahead and use those, because if you've got a question, everybody's probably got a question. So don't hesitate to use Moodle as a good methodology where everybody can kind of see what's going on. I'm going to try and spin that back. If you're uncomfortable going, hey, I got a question, I don't really want everyone to see that I got the question on Moodle, send me an email to my email, and I'll excerpt the question. I'll post it up to Moodle and go, one of the students had a question, or one of your fellow students had a question. Here's a question. Here's how I would answer it. Does anyone else have any comments? So we'll interact between classes as much as possible on Moodle. One, it's a common spot where we can all find it. You don't necessarily need to be in any particular spot because you can log in from anywhere. And second, it kind of keeps track of what's going on. And it'll help me keep track of, okay, if I've got a concept that folks look like they're having problems with as you're going through the week and kind of doing the quizzes and going, yeah, this isn't quite sinking in. If you get that back to me by email or on Moodle, then I've got a better idea coming into the class instead of you hitting hold with I had a question on this concept. If you get it ahead in Moodle, not only can we start discussing it online before we get here, but it also gives me a better chance to go, okay, I know what some of the problems are, some of the questions are. Let me queue up some examples ahead of time so that we're all ready to go. Any questions on that approach? All right. It's a time-intensive class, and more so because we're not together. I can't stress enough that the quizzes are long. There's a lot in there. And when you look at chapters 1 through 4, you may have 75 questions. Each one could take you 2 to 3 minutes, with some being 30 seconds, because it's like, what is the definition of common stock? And okay, that's an easy one, take you 30 seconds. Others are going to be math problems, where it's going, given this, this, and this, calculate the weighted average cost of capital. Given this, this, and this, calculate the present value. Those are going to take you a little bit longer. I would recommend, think of this more like a math course for your off time. So in class, it's more of a, let's talk about some of the issues, some of the problems. Let's walk through the issues and problems. When you're out and working during the non-in-class period, so the online portion and the take-home portion, think of it like a math class where you really are going to have a lot of problems to do doing those problems and doing them well, and you've got it's open book, open notes, is going to give you the fundamentals that you need and the practice you need to be able to kind of understand where we're coming from. So spend the time to do it, but it is going to take a fair bit of time. So plan the time wisely. All the quizzes are open today. You can take every quiz, all 5 or 6 quizzes you can take today, all the way through the end of the class. The midterm will open up a week prior to it being due. You'll have 2 weeks to do the midterm. Plan your time accordingly. Get in there and start working the problems. As you start working the problems and you run into blocks or bumps, fire those back up in the Moodle or fire them to me by email, and I'll get them up in the Moodle, and we'll start talking about it, and that'll set the tone for the next class. It's quantitatively intensive. Like I said, it's not quantitatively hard, but it's quantitatively intensive. We're going to walk through, and I've posted out on Moodle a ton of videos on Excel and Excel formulas. How many of y'all are comfortable with Excel? 3, okay. I'm not a big fan of, and the book will talk about, and sometimes even the homework problems will say, use your financial calculator too. No one uses a financial calculator anymore. I mean, I think I might have one in here, but I probably haven't pulled it out in 2 years. No one uses financial calculators. The world uses Excel. So we're going to use Excel in this course. I want to make sure that when you leave here, when we're done with the next 8 weeks, if nothing else, you're comfortable enough getting in Excel and going, okay, here's a formula wizard. I can pull down a formula wizard. I can fill out a formula. A lot of what you're going to find I think what we end up doing in this class during the class time is going to be walking through how to set these formulas or how to set these problems up in Excel, and you guys getting comfortable using the Excel formulas. Like I said, there's about 12 videos that I put up from Highline College on Excel and kind of the basics of Excel. Take some time to go through those. If you're not comfortable in Excel, take a little bit of time and get yourself comfortable in Excel. Google Sheets is your other alternative. It's your free alternative. It basically is 70% of Excel. It's good enough. But if you have Excel, use it. And like I said, it's quant intensive, but it's not hard. The worst we're going to get in this class is going to be algebra and exponents and division, addition, multiplication, subtraction. It's not, there's no real heavy duty, there's no trig, there's no calculus. And so don't let the math, you got this far, don't let the math worry you. And focus on the general concepts. So we're going to talk about things like time value of money. When we get into some of the storytelling tonight, buy into this approach. Buy into the storytelling approach. When you get through to the final exam, and certainly when you get done with this class, and you're out working, most people are not going to be as worried about your math, and are going to be more worried about, okay, you've done the math, that's great. What does it tell me? What does it really mean? What's your analysis of the data? And we're going to talk, I'm going to show you how to do that with the balance sheet income statement tonight. But what's the analysis of the data? That's more important. So focus on the general concepts. When you get to exam time for me, focus on the general concepts. You're going to get 70% of the way there. Even if your math is wrong, if you show your work and go, I tried this, I might have picked up the wrong number or done something wrong, that's fine. If you then can interpret even the wrong answer, if you interpret the wrong answer the right way, you get full credit. So you'll get partial credit because you didn't calculate the thing right, but for that 70% of understand the general concept, you'll get full credit. Talk about the textbook. I'm recording this lecture. I'll record all the lectures live on YouTube. I use Google Hangouts. No guarantees. So every once in a while, this thing glitches out. It'll record for the first 59 minutes and stop. I'll forget to hit start, which is what happened to my morning class. And there's no substitution for attendance. So you got to be here. And of course, we take attendance every class. There's only 6 of them, really. So make sure you're here. This is the part that I was talking about with finance. I want you to think about every finance problem being a story. Unless you're, is anyone in here like super quant? Anyone in here like wish they were a math major, but we don't offer it on base, so you became a business major? Okay. If you were super quant, then I tell you, think of every finance problem as a math problem. But since we're not, and that's myself included, think about every finance problem as a story. Try and get your head around what they're really trying to solve for. Because if you can do that, that will at least start directing you to the concept that you need. So think about it as a story. We're going to talk through some stories tonight. Think about what issues are there. Use your common sense. You guys all have valuable life experience you bring to bear in business every day. And sometimes you're like, this just makes no sense. It probably doesn't. So in finance problems, there's going to be a choose A or B. 70% of the time, you're going to know whether they should choose A or B because your instincts are going to tell you. Now you got to back it up with the math. But if your gut says go one direction, you're probably right. Use your common sense. Don't leave your life experience at the door, especially once you get out of this class. Finance is just a tool. And think about it as a story. And what are you trying to solve? The other part is have fun and engage, and especially in a class this small with this much material. You'll learn it better if you engage it. You'll learn it better if you engage in class. You'll learn it better if you use the tools at your disposal, the email, the Moodle, but get into it and try and have fun with it. Because if you don't, it's going to be a miserable 8 weeks. And so try and enjoy it as much as you can. Engage in the class as much as you can. Don't worry about the grade. The grade will come. But try and have fun with the process. Any questions so far? All right. I'm going to cover briefly some material out of chapter 1, 2, 3, and 4 that you guys need that are fundamental. I normally try and break us right about 6:30, and then again at 8 o'clock when we're done. If y'all need to use the facilities, go do it anytime. I'm not going to hold you in here. This is an elementary school. I know that we start at 5 and go to 8. That's normally dinner time. So if you've got to bring your lunch or dinner, bring it in. I don't care. Just make sure you clean it up afterwards. I want to make sure that this is, and if you've got any accommodation you need, let me know. So sometimes folks are like, hey, I've got kids, I've got to get out of here at 7:30 so I can be home by 8 o'clock because that's when the sitter has to leave, etc. That's fine. Just got to keep me posted on what's going on. The other piece that I'll tell you guys is, as a group, we're relatively small. So get to know each other as we're going through the process. If you guys don't know each other already, get to know each other as we're kind of going through it. It's going to help you through the class. I'm going to cover off, like I said, some of the material in chapters 1 through 4 that's most critical. It's going to feel a little bit fire hose from here on forward. And what you're going to hear me say is, have you had this before? So in your St. Martin's world, or as you're kind of have rolled up to this point, there's classes like business law, BA300. There's the accounting classes, there's quant methods. You guys may have had some of those before. And if you have, I don't want to dive deeply into things that aren't necessarily going to be critical. If you haven't, say, hey, Ed, slow down. And I'll slow down, back up, and cover off those things that you're going to need to know that are most critical for the course. The last thing that I'll tell you is my background is such. I'm originally from the East Coast, and I've been at St. Martin's for a couple of years. I still have not necessarily done well buying into the things like pure gender neutral pronouns. So sometimes I say you guys. It's kind of because it's use guys from home. It's not because I think you guys are guys. See, I did it accidentally. So for that, if it bothers you, let me know, and I'll work on fixing it. But it's not intentional. It's a colloquialism that I have had trouble pitching since I've been out here. So in chapter 1, we're really focused on what is finance. I'm going to hit on a few critical items, but one of the most important things we're going to walk out of here tonight with finance is finance isn't just about numbers. Once we get past this segment of the class, we're all going to talk about numbers. We're really going to dive into numbers, but it's not all about numbers. We're going to talk a lot about, at least tonight, we're going to talk a little bit about ethics piece, which isn't really in the book, but we're going to talk about it, and we're going to talk about it in light of St. Martin's. So finance is really focused on cash. You've all had accounting. Has anyone not had accounting in here? Okay, so you've all had the accounting prerequisite. You haven't had accounting either? No. Okay. Welcome to Fire Hose. So accounting basically records what has happened historically. And those of you who have taken accounting know you can make your books say a lot of different things depending on what type of depreciation method you use, how long you decide to amortize something, whether it's deferred or accrued. There's all sorts of things that accounting can do that really can mess with your numbers, make a company look profitable when it's not, make a company look not profitable when it is. For finance, we're focused on cash, not on accounting. And we're going to talk about the differences, and some of today is going to be focused on some of those differences that you need to be aware of as you look at financial analysis. Everything else being equal in finance, more value, and this is all common sense stuff. More value is preferred to less value. The sooner you get the cash, the more valuable it is. So if I said, hey, you can have this stuff, you know, I'll give you $1 today or $1 in 3 weeks. Which would you rather have? I want $1 today. Because 3 weeks from now, you might have gotten hit by a bus. You might not be around. You might not pay me. For 3 weeks, I'm not able to buy the latte that I'd buy with the, well, maybe you can't buy a latte. I'm not able to buy the $1 cheeseburger that I might be able to have otherwise, so I got to wait. I should be compensated for that wait. So sooner I get the cash, the more valuable it is, all things being equal. So it's $1 now or $1 later, I want the $1 now. Less risky assets are more valuable than riskier assets. So if I said, look, I'll give you $2 or I'll give you a lottery ticket for which I paid $1, but it could pay off $1 million, which would you rather have? $2. Because one is worth expected value of 18 cents, 22 cents, the other one's $2. One's a risky asset, the other one's less risky. If I said, hey, you can have a share of IBM, or you can have a share of John's Subway Shop, they're each $100, which would you rather have, all things being equal? Most likely IBM. Although we'll dive into why you might choose the other later and why that risk is built into the price, but generally you'd prefer to have risky assets if the value is the same. So when I was at Notre Dame, I had this ancient professor named Dr. Paul Conway. And Dr. Conway had this little pithy statement. Money has a time value, time has a money value. Who wants to explain to me what Dr. Conway was talking about?
You go back to what you were saying just now, money has a time value. We want our money now.
Right.
Most times. I mean,
yeah, you want money now or what?
or a lot more later.
You want more later. I'll either take what I get now or I'll take more later, but I ain't taking the same amount later. So money has a time value in that money today is worth more than money tomorrow. Over time, you have to be compensated for giving someone money and having them hold it. What do we call that? Say again? Interest. It's a loan. I gave a loan out. I want to get paid back with interest. That's money has a time value. And we're going to talk a lot about time value of money in here. What about time has a money value?
Have to make it worth getting money. I mean, like in that instance we just said, if I'm giving you a loan and we give it back over time, it has to be worth it to me.
Yeah, you're on the right track. How many of y'all will work for free? Because if you will, I got a job for you. Your time has a monetary value associated with it. So how this works in finance, and you're hitting on it tangentially, how this works in finance is, hey, your time has a monetary value attached to it. If I make you wait for compensation, you're going to go, I'm going to work somewhere else where I can get my compensation faster. If you say, hey, I'm going to pay you $100, I'm going to pay it to you, for your 2 hours worth of labor, I'm going to pay it to you in 2 weeks. You're without the opportunity to spend that money. You've given up your time without compensation for 2 weeks. So you're going to go, hey, is that worth it to me or not? Every moment has value. And more importantly, as you get old like me, you find that time you can't get back. You can always make more money. It's tougher to make more time. However, with enough money, you can buy yourself time. And here's the example. Let's say you've got a car and it needs an oil change. You can either take $35 and go pay someone to do the oil change for you in 15 minutes, or you can use an hour of your time and do the oil change, and it's going to cost you $5. And so when you've got enough money, you can buy yourself free time. And so you've got to look at these trade-offs. This is kind of the economic side of it. You got to look at those trade-offs and go, would I rather have time or would I rather have money? Because I could trade the two. So money has a time value, time has a money value. And I could trade those two things, and the two things are intimately related. So as you go through the decision-making process here in finance, we're going to look at things like time has a money value and money has a time value, and try and come up with how to analyze that. There's a few general areas of finance, markets, and institutions like the stock market, investments like stocks and bonds, financial services like loans, and managerial finance, which is how firms, companies, corporations make financial decisions. We are really focused on this piece in this class, managerial finance. We'll necessarily touch on each one of these other things, but this is essentially BA300, which is money and banking. You've got investments, and then you've got financial services also included in BA300 or BA311, and we've got a little bit of overlap here in managerial finance with all of these. But we're focused on managerial finance. We could spend semesters on each one of those 4 components. So I want to make sure that as you're going into it, when you're thinking about things, think about how it relates to the firm, not necessarily how it relates to your personal stock portfolio. I'll try and tie the two together to show relevance. But really, we're focused on companies. For everybody in here, outside of Tom, all right, because you're my finance guy. For everybody else in here, we're going to talk about how finance touches everything and why this is so important. So all areas of business, marketing, management, accounting, production, information systems are affected by general finance concepts. How? Anyone want to hazard a guess? How many marketing majors we have? Talk to me about how finance and marketing interact.
You need to have funding in order to promote a business and put out ads and do consumer behavior research and things of that matter. So finance plays a role in that by allocating funds and
So talk to me about allocating funds. What do you mean by allocating funds?
budgets.
How do you think you come up with budgets in marketing?
You don't. You request to your manager for things that you may need for the upcoming quarter, and then they submit their first initial budget, and then it goes to accounting, and accounting decides what they can or cannot put into that quarter.
we're going to dig deeper into that. You're going to find that there's a little bit more method than that is, and even coming out of this, hopefully you're walking out of here in a few weeks with more ammunition to get better budgeting. So if I said, I'm going to give you $5,000, and you've got a choice between online ads or the yellow pages, which are you going to choose?
Online.
Why?
Because everything's going towards technology and knowing videos is a comfort right now.
So what's online ads going to do for you?
It's going to hit your target market.
Which results in
Money.
more money, more sales. And so you've already got this concept of return on investment. So when you think about capital budgeting, which we're going to dig into, complex math, all that stuff. If you look at capital budgeting, you're going, okay, look, I've got a choice. I could buy 5,000 of this, or I could buy 5,000 of that. I could buy 5,000 of online ads. I could buy 5,000 of yellow page ads. My expected return, expected future cash flow associated with that decision is maybe $2,000 for yellow page ads, $50,000 for online ads. So my return on investment is calculated at 10x over here and 0.5x over here. So I'm going to invest over here. That's finance. It doesn't, we can make it into rocket science, but it's not rocket science. That's how you can look at finance as it relates to marketing. How about management? General management. How would you think about operations management, manufacturing management? How would you think about a finance concept there?
I think it's the same thing. Everything takes money. I mean, if this says production information, IT, I mean, does your business have computers? Does it have software it needs? Things of that nature. Everything takes, money that we're talking about.
And money is a limited, there's a limited amount of it, right? So every company, and let me make sure I'm starting to get my, so you're Maria, right?
Yeah.
Okay, so what Maria had said was, look, I submit this request to accounting and they tell me what I get back. The more power you have behind that request to show the accounting department that, hey, that is going to come back. I'm going to put these two little dollars together and they're going to go out and they're going to come back and they're going to come back with $10 attached to them. The more power you have around that decision making, the stronger you're going to be. So in the case you just talked about, where you're talking about computer systems, you may go, hey, look, the cost of being down because our disk array is going to crash because it's 7 years old is going to be this much. The price of a new disk array is $100,000. So the cost of being down times the probability of it going down is going to be $220,000. So therefore we should buy today. Every decision you make, whether it's hiring another salesperson, whether it's switching benefit plans, whether it's changing, because again, you're going to go, how much more is it to retain somebody versus recruit somebody? Those kind of decisions, buy a new piece of equipment versus use an old piece of equipment. Every one of those decisions has a financial implication behind it because money is a limited resource, and you want to show that your decision has a financial basis to it, that it's going to have a return on investment, that you're not just going, well, I want to get this newest thing because I want the newest thing, but really showing that the decision behind it is based in some fundamental economics, knowing that the amount of capital available, amount of money available is limited. And so every time you touch a decision, you're going to have a finance application to it. So I'm going to point out a couple areas where you tend to see it. Sales, if you're in sales, the decision to extend credit or to not extend credit to a customer is a finance decision. Can they pay you or not? Because otherwise you're going to end up with a charge off and your commission may go backwards. How much inventory to hold? Because when you buy inventory, you're basically putting money out today to buy inventory and you don't get the money back until it's sold. So it's tying up cash. How much inventory to hold? Director of Capital Budgeting, Operations, Capital Budgeting. Should I buy this new piece of equipment or not? Should I invest in a new plan or not? Should I build this new product? And if I do, what do I expect the sales to be over time? We're going to show how to analyze those kind of decisions. Okay, I want to build a new product. It's going to cost this much in R&D. And then over time, I expect this much in sales. I expect it to cost this much to manufacture, and therefore I expect this much in profit. Should I do it or not? That's capital budgeting. And then you got the traditional stuff, financial and cost accounting and taxes. Taxes are really important in finance because we care about cash. So decisions you make around how you depreciate and how you account for your inventory and those kind of things drive your taxes, which drive your decision-making process. So we're going to talk a little bit about tax. You're going to see tax flows in and out of the formulas, and the effective tax rate is an important input. Any questions so far? We're not going to cover business organizations except to say that the bulk of what we focus on in this class are corporations. And we're focused on what we call C corporations. I have no accountants in here, right? Okay. So we're going to focus on corporations that are tax-paying entities. Does anybody want to go through or not understand the difference between partnerships, proprietorships, and corporations? Okay, the biggest thing to remember, corporation, which is where we're focused, is you can raise money with stocks and bonds, and there's double taxation. So not only are the corporation's profits taxed, but when you distribute profits to shareholders, those are called dividends. When you issue a dividend, that's taxed at the individual level as well. So you've got this concept of double taxation. Right now, most companies are formed as LLCs. And the reason for that is because they're cheaper and easier to set up, less compliance, but you can't sell your stock to everybody. So a lot of your private companies are LLCs, your publicly traded companies tend to be corporations. You'll get a couple questions on the quizzes on this. If you have any questions, we can cover them next class, but it's not critical for finance. What is critical for finance, and as we transfer and as we shift into ethics, there's a concept here of moral hazard. Essentially, that limited liability creates a moral hazard for managers and creates a moral hazard for stockholders. So limited liability reduces risk. Everybody know what limited liability is? Limited liability is when if I invest money in that company, the total amount I can lose is the amount I invested. Unlimited liability means they can not only take the money I invested, but come after me personally. So most corporations have limited liability. It's easier to raise capital, which is other people's money normally. So management runs the company, but other people, they're normally using other people's money as the investment. And ownership is easily transferred via stock transactions. So there's liquidity. The primary goal of a corporation is wealth maximization, which is the same as maximizing the stock price. Anybody disagree with that? Anybody?
And so if the company gives their employees investing in stock, right?
Why?
Because if the employees are stockholders, they're going to work harder to maximize their wealth as well. They have no stock in the company, it's a lot harder to encourage employee productivity.
So that gets to the second bullet, kind of managerial incentives, and we'll call it employee incentives. Normally, when you think about IBM, how much stock do you think the chief executive officer of IBM holds? How much percent of IBM do you think she holds? 5%.
I would think you had a lot. At least half.
Think half.
I said quarter.
Quarter of the stock. CEO of IBM probably has less than 0.1% of the outstanding stock of the company. We're going to look at IBM's annual report later. Management normally in these big public companies owns a small fraction of the company, a fraction. So they provide incentives so that they're aligned, so that they're trying to maximize stock price. But in general, management has other incentives as well. You want to try and align it so that they're bought in to maximizing stock price. But generally, management will operate in their own best interest. You want that best interest and the shareholders' best interest to be as aligned as you can. But how many managers do you know will walk up and go, hey, I'm just not that busy, you need to lay me off? That's going to help maximize the stock price. Does that happen? Not too often. Even if they're incentivized and aligned, you tend to operate, we all operate in our own self-interest. I mean, every one of us. Argument, even from economists, would say that when you're acting altruistically, when you're helping someone else, you're doing it because it makes you feel good. And the way you feel, the good you feel, is worth more to you than what you're expending to help somebody. Therefore, you're operating in your self-interest, even if you're being altruistic about it. Now, it's a little cynical, but economics will tell you it's true. And when you take economics, if you haven't yet, you're going to get exposed to utility theory and essentially this, we all operate in our own self-interest. We want to align those interests as best we can, but there's always going to be divergence. And social responsibility, why is social responsibility important? Why?
Like there's laws saying.
Yeah, but why? Why can't it? Like, I mean, wouldn't it be cheaper for me to like just take my bad chemicals and dump them out back? That'll maximize stock price. I don't have to pay to dispose of them.
Yeah, just people die, and the company eventually will just dissolve. Since
And you get
so many lawsuits, they'll be buried under lawsuits.
Yeah.
And people find out about that, that they ruin their reputation because of social media information getting out so quickly.
So you guys have hit on it. Essentially, there's methodology. So the market isn't always efficient. And where there's market inefficiencies, essentially that's where regulation comes in. And there's costs that you can put on society, like dumping stuff out back. That regulation says, no, you're taking a cost that you should bear and transferring it to society generally. You need to bring that back in. And so regulation and laws and lawsuits, courts, basically force this social responsibility. But there's study after study after study after study that show that, and we'll talk about this more in light of corporate governance, that diversified boards and socially responsible corporate governance and socially responsible corporate behaviors actually result in higher returns to shareholders than those who have non-diverse boards and those that are not socially responsible. Social responsibility, people go, oh, it costs us money to do that. I don't want to do that. That costs, over time, the companies that practice social responsibility tend to perform better than those that do not. And it's because at the end of the day, reputation and external costs combine together to actually suppress the stock price. The chickens always come home to roost. There's 3 levers, and we're going to talk about all 3 of them by the end of the course, that you can use to maximize shareholder wealth, maximize the value of a company. The first one is capital structure. How much in bonds and how much in stocks should I have, and how much debt and how much in payables? What assets should I have, or how much in payables? That's your capital structure. How do I pay for stuff in my company? The second is capital budgeting decisions. So what projects do I undertake? What equipment do I buy? Do I buy or do I lease? How much inventory do I hold? And then you've got dividend policy decisions. How much of my earnings do I retain in the company, and how much of my earnings do I pay out to shareholders? These are the 3 levers financially that companies use to drive their stock price. They're the 3 things that drive cash in the business. How the company's financed, what the company invests in, and how it reinvests it's profits. And we're going to focus on those three elements in this course. This is a very busy slide. And by the way, these slides are all up on Moodle as well, so you can look at them to your heart's content. But you can see essentially that there's two key components that drive the value of a firm from a finance perspective. Net cash flows and a rate of return, or the risk. Everything we're going to do in this class is going to boil down to net cash flows and figuring out what the risk of the firm is, combining those two things together to come up with a value. Every project we look at in here is going to be cash flows and risk. Every company we look at, cash flows and risk. Every bond we look at, cash flows and risk. Every stock or preferred stock, cash flows and risk. It boils down to cash flow and risk. Finance is really about analyzing, how do I get to the right cash flows? How do I determine what the risk of the firm or the project is? How do I mush those two things together and calculate what the present value of the expected future cash flows are? And that's my value of the firm. There's a lot of other stuff that goes into the analysis of it, but it boils down to cash flow and risk. Any questions on this very busy slide? If you buy into cash flow and risk, and when we get risk, we'll get CAPM, which is my favorite thing. When we get into cash flows and risk, once you understand that those are the two key components of finance, the rest of it kind of takes care of itself. Everything comes down to cash flow and risk. Factors that influence stock price: cash flow, timing of cash flow, risk of cash flow, use of debt, and dividend policy. I know it sounds redundant, but again, that's what finance is. It's these five factors. We're not going to talk about agency, but we will talk about stockholders and managers. Managers are inclined to operate in their own best interest. You are inclined to operate in your own best interest. I am inclined to operate in my own best interest. Our job as managers, and most of you are management or marketing majors in here, our job as managers is to get our folks aligned with our company, get our folks aligned with the mission. At the end of the day, that's what our job is as managers, is to get alignment and drive alignment. And there's methodologies to do that: managerial compensation, incentives, things like stock options, bonuses, shareholder intervention. So let's talk for a moment about how corporations are managed. Does anyone here know how a corporation is managed? Anyone want to fathom a guess or an explanation? Yes, ma'am.
You have a CEO, and then his board of directors, and then managers, and then the team.
Almost.
Is that kind of question?
Yes,
Sorry.
but almost. The way you described it is how it functionally tends to work.
Yeah.
That's not how it's supposed to work. So who's at the very top? Nope. Stockholders. And who do the stockholders elect? A board of directors. And who does the board of directors hire? The CEO. And who does the CEO hire? Everyone else, for simplicity, everyone else. Here's, Maria, where you're right. Most of the time, the CEO has significant influence over who the board of directors are. They tend to be buddies. They're pals. And so what happens is when someone leaves the board, so initially, let's say that there's a vacancy. CEO retires. They go to hire a CEO. The board goes to hire a CEO. Who do you think they hire? Their buddy, their pal, someone they know, someone like them. Someone who's not going to be a threat. So they go hire a CEO. Now the board members eventually get board member retires. Who do you think appoints a new board member? The board with the input of the CEO. So you create literally this old boys club. Because that is truly what most boards look like. And they self-perpetuate. So really the governance is functionally very much like you described it. You have a CEO and then you have a board. And that board kind of sort of holds the CEO accountable, but really doesn't unless the CEO pretty much runs the place off the rails. Otherwise, they all cold hand sing kumbaya. And then, because the board of directors doesn't own much stock either. And the shareholders, you know, when you think of Apple, there might be 2 million shareholders. So they don't really, it's tough to get them all in a room and convince them to go fire the board of directors. And then when they float someone up for the next board of directors, it's generally going to just get voted on yes, and it's done. So what's a shareholder intervention when we're talking about? So let's say managerial compensation doesn't work. And these guys are basically, and I'll give a story. Before I came to St. Martin's, for 15 years, most of the work I did was with private equity companies. Private equity companies are companies that buy other companies, take them private, and turn them around and sell them, break them up. So it's kind of, if you ever watch like other people's money, or the Gordon Gekko stuff from back in the 80s, that was the kind of work that I did, which is why I'm now at the university, because it's hiring. So there was a company called Lone Star Steakhouse and Saloon. Those of you who have been in the military and have been down in the South know Lone Star Steakhouse, because they're all over the place. And they had Texas Lamb and Cattle in Texas, because you couldn't have Lone Star Steakhouse in Texas. So Texas Lamb and Cattle, Lone Star Steakhouse. The private equity firm that I worked for went and bought the public company Lone Star Steakhouse and Saloon. Why? Lone Star Steakhouse and Saloon had 7 private jets. Each of the district managers of Lone Star Steakhouse had an Acura TL as their company car. The CEO had multiple company cars, but the nicest ones were over $100,000, Mercedes S600. The CFO didn't like the S600, so he had an AMG S55, which was a $140,000 car, plus an Escalade, because in Kansas it snows. The general counsel had an Infiniti. There was money, they were just burning public shareholder money all over the place. And so what happened was this private equity firm did the analysis and said, these guys are wasting money. We're going to go in and put a bid in and get the shareholders to sell. Threat of takeover. We ended up buying out the company. We sold the jets. I was the interim CFO for a year. We sold the jets, sold the cars, downsized the headquarters, moved it to Plano, Texas. And then the recession hit. We're actually, the company's still alive today. We survived the recession. It was pretty stressful. But that's a takeover. Shareholder intervention is in the middle. Basically, the shareholders look at this and go, you guys are taking my money. You're misusing it. We have these incentives in place and you don't care. Because you get a $40,000 bonus or you get a $125,000 Mercedes. You're going to buy the Mercedes because that's what's in your best interest. So I'm going to intervene. I'm going to boot the board of directors, hire a new board of directors. They're going to then approve the takeover and we're done. So this is what happens when the shareholders' interests and management's interests aren't aligned. And it happens over and over and over again. We're going to talk a little bit about ethics. Ethics are a standard of conduct and moral behavior. It's how a company interacts with its stakeholders, employees, customers, community, and other stakeholders, stockholders. Law is the floor. Ethics is above the floor. It's not ethical to just say, I'm not breaking the law, so it's okay. Ethics is doing the right thing, not just doing the legal thing. You might not go to jail if you don't violate the law, but you're probably not holding yourself to a high enough standard. We're going to talk a little bit about some of these ethics. So how many of you guys have heard of a Ford Explorer? Ford Explorer. So let's talk a little bit about Ford Explorers. Ford Motor Company builds the Ford Explorer. It's built them for many, many years, going back into the early 90s. Ford Explorers were equipped with Firestone tires. Anyone know why Ford Explorers were equipped with Firestone tires?
They had a partnership with Firestone?
They had a partnership with Firestone going back decades. And Firestone was the cheapest tire that they could put on that truck. Now, the tires that they put on the Ford Explorer weren't necessarily rated for the Ford Explorer, but they were pretty inexpensive. And so Ford equipped all its Ford Explorers with Firestone tires. They weren't designed to have the weight of that particular vehicle, particularly the ones with the V8 engines, weren't designed to have the weight of that particular vehicle on them, let alone for off-road use, let alone when they were overweighted, filled with people and cargo. So what do you think happened when you had kind of the wrong tires on that truck? Accidents happen. Ford Explorers had a tendency for rollover. And the rollover occurred because the tires weren't the right tires, weren't rated properly, so they had blowouts. Normally when the truck was overloaded. Now when a truck is overloaded, it's normally overloaded with people. So you have a lot of injuries, you have a lot of problems. And Ford said, well, the reason I did that was these were cheaper tires. So they got recalled and sued. Is that illegal? Is that ethical? No.
It is legal, excuse me.
It is legal.
It is legal, but it's not ethical.
It's not ethical. And so Ford ended up having to pay hundreds of millions of dollars in damages. 30 years prior to that, 25 years prior to that, Ford had another issue with one of their cars called the Ford Pinto. How many of you have heard of the Ford Pinto? So the Ford Pinto, this is where finance can get you into serious trouble. The Ford Pinto the hatchbacks had a gas filler problem. Would have cost about $2 per car to fix. But Ford took a look at it and said, we're building a lot of Pintos. It's going to cost us a couple $1 million. We figure that there'll only be about a dozen accidents, maybe 2 dozen accidents where the car's going to get hit in the rear and explode. And for each one of those, we might have to pay out $15,000 to $25,000 of damages for people who are hurt or killed. So it's cheaper for us to not fix it and to pay out the damages than it is to fix the car. Is that legal?
This is America.
Like premeditated, people dying, it seems legal, but.
It was legal. Is it ethical? So here's what happened. Car gets hit. Boom! Explodes. Kids die. This was in Oklahoma, I believe. Kids die. This is bad. Ford gets sued. Part of the lawsuit process, again, my profession as a lawyer, I tend to go down these lawsuit things. Part of the lawsuit process is this piece of this lawsuit called discovery. And discovery is a process whereby each side exchanges information. So the plaintiff, the people suing Ford, said, we want all the materials associated with the design of the Ford Pinto, because there's been a couple of these rear-end explosions, and we want all the design documents. Part of the documents that were produced for that case included a memorandum which had that financial analysis in it. What do you think happened when the jury saw that piece of financial analysis? How do you feel when Ford goes, well, it's going to cost us $2.1 million to fix it. It's going to cost us $800,000 in damages, so don't fix it. We'll just let people blow up because there's not going to be that many of them. How does that make you feel? You a little pissed off? Yeah, the jury was pissed off too. So they hit Ford up for 20 times the amount of money they thought they were saving. Called punitive damages. Basically punishment, don't ever do it again. Finance will tell you, pure finance would tell you Ford made the right decision based upon the pure numbers. Ethics tells you they made the wrong decision. Not covered in this book. But what I'm covering here is as you go through and look at things like finance, it is easy for us to reduce people to numbers. It's easy for us to reduce decisions to numbers. It's easy for us to justify bad ethical decisions using numbers. And we can't do it. We have to get above it. We have to look at things like the social cost. We have to look at those areas that are outside the obvious of the analysis and go, is this really the decision we should be making? Because ultimately it will come back and get you. It is not good for your business. It is not good decision making. After this class tonight, we're going to dive into numbers. We're going to be focused on those numbers. We're going to be saying, do this, do that based upon those numbers. But if I can leave you with one piece of information tonight, it's don't allow the numbers to be the sole determinant of a decision you make. And finance makes it easy to do that. Makes it really easy to do that because we quantify everything and we put out information. And remember that there's social costs associated with it, and we have to look at the ethics behind the accounting. I just used 2 Ford examples. We could use bank examples from the financial crisis in 08. We can use examples like Enron from 2000 where they manipulated energy numbers. And again, in some cases that was perfectly legal, but it was completely unethical. Those companies ended up paying massive prices. Not only the companies, not only their officers, many of which went to jail or some of which went to jail, their stockholders, their employees, everybody paid a hellish price for unethical decision making. And so again, one of the benefits you get at coming to St. Martin's is we're a Catholic Benedictine college. So you end up getting ethics. You should get ethics in every class. And we should be emphasizing our heritage in that not just the numbers matter. So I'm going to kind of step away from this ethics slide. Any questions on that tirade? Because you won't hear it again. It's not on the test. Okay. Corporate governance. I'm going to leave you with this one piece. Good governance generally generates higher returns to stockholders. There's no financial penalty long-term for doing the right thing. Good governance includes separation of duties. Good governance includes oversight of management by the board. Good governance includes a diverse group of board members. Generally and traditionally, if you look at Fortune 500 boards, they're cross-populated. We generally have a bunch of white guys aged 50 to 75. And the AT&T guy is going to be on the IBM board. The IBM board guy, the IBM CEO is going to be on AT&T's board. They're both going to be on Ford's board. Ford's going to have one guy on the AT&T board. GM's going to have one on the other board. And they're all, if you look at the makeup of Fortune 500 companies, their boards, and it's changing over time. Many of them are cross-pollinated and cross-populated with buddies. Most of those buddies are 50 to 70-year-old white males, and there's a lack of diversity, and there's a lack of diversity of thought, and there's a lack of accountability because they're all buddies. Those companies who have moved past that and said, we want not only diversity in terms of ethnicity, in terms of race, in terms of sexual orientation and gender, but also we want diversity in terms of socioeconomic status. So folks who bring in members of nonprofits to their board, to for-profit boards, to bring a different perspective, have tended to do better over time. So it's something that as governance continues to improve and as people continue to look at this, there's light being shown on the cross-pollination of these boards and really trying to get more diversity in those boards. Sarbanes-Oxley in 2002, which was a result of the Enron crisis, also helps. For folks like myself, who was the chief financial officer, I had to personally certify financial statements. My chief executive officer, and I've been a chief executive officer too, we have to certify financial statements. We're held personally liable if they're material misstatements and we were aware. So that limited liability of the corporation doesn't necessarily extend to the CFO and the CEO if they were aware that there's problems on those financials and they certified them. That didn't happen prior to 2002, but that has happened now. And that's holding the chief financial officer and chief executive accountable. We're not going to talk much about foreign and multinational, but there's a few reasons why companies might want to go international. And I'll give a little bit more of my background. Immediately prior to coming to St. Martin's, the last job I had, I was the president and chief operating officer of a tech company in Bellevue called G2 Web Services. G2 Web Services did some interesting stuff. We had offices in London, in Shanghai, in Sydney, in New York, and in Bellevue. What we did was surf the internet. We had proprietary crawlers that were built on Lucene, which is a open source technology. And we crawled the internet. Our clients were big banks, Visa, MasterCard, Discover, Western Union, American Express, Barclaycard, Interpol, Europol, ICE. What do you think we were looking for? So the company, what we did was we searched the web, dark web and light, to look for bad actors selling bad stuff online. Because if you think about criminal activity, the best way to shut down criminal activity, except for the real sickos, is you shut down the money. So we had all those banks would give us credit cards with their name on them, because they don't want to be associated with child pornography, with child trafficking, with human trafficking, with drug dealing, with selling automatic weapons and other stuff online. So we would go crawl the internet, millions of web pages. We would find bad stuff, and we'd use these cards that were essentially like marked bills. We'd buy cocaine, we'd buy child porn, we'd buy bestiality, pornography, we'd buy machine guns and grenades and explosives. And as soon as that went through the system, Visa, MasterCard, the bank, everybody else knew who the bad merchant was, they'd shut them down, and ICE, Europol or Interpol would be notified, and you go try and figure out where they were at. The biggest ones that we ran into that were selling stuff online was illegal drugs. And not necessarily cocaine, although that's there, but more prescription drugs. Why do you think we had offices in all those spots? It's kind of an interesting business, but it's tough to explain to my kids what I did. Why do you think we had international locations? So you've got at the bottom regulatory hurdles. The EU required us to have our servers that were working on the EU, that were working in the EU, to be behind the EU. So essentially being an EU-based country, Ireland is working with them, because they wanted to be able to have regulation over them because we were getting a bunch of illegal stuff. We're working with Europol and Interpol, but they still were like, we want to make sure you're regulated by us. So we're making sure that we've got our tentacles in you in case you become a bad actor. So you had regulatory hurdles. We had to be in there for regulatory purposes. Why else? Pretty much these 5 reasons: seek new markets. So one of our biggest growth markets was China and counterfeit goods. So Shanghai was one of our locations, and we're like, okay, we want to get near the Chinese banks and explain to them why allowing them to process credit cards for counterfeit goods is a bad idea. Seek new technology. Where we tended to see the fastest growth in technology was in Europe, not here. Bad guys operate really well out of Europe, especially Eastern Europe. And so new technology, the closer we were to the bad guys, the closer we were able to keep up with them. Production efficiency, in some cases, is cheaper, and or being closer to the customer is cheaper for us to actually manage, and then political and regulatory pieces. So again, there's reasons why you end up in these foreign countries. They factor into your financial decision making. The tax structure, the risk associated with it, whether it's political risk or language differences and other things, the risk of a foreign investment tends to be a little bit higher than it is if it's domestic, because you've got other factors at play: currency risk, political risk, other geopolitical factors. We're not going to dive into that heavily in this class. It's going to pop itself up a little bit on quizzes. The company we're going to analyze at the end of the semester is going to be an international or a multinational. And so be aware that there's other risk factors at play. Bring those forward. That's going to impact, remember I said cash flow and risk. International tends to impact that risk piece. Repatriation of cash is important. One of the big deals with the new tax law that passed is they reduced the taxes for corporations to allow them to bring back money that they had been storing offshore. And so Apple said, well, we're bringing back $200 billion and we're going to pay $38 billion in taxes. Woohoo! That's part of this financial piece. Again, there's international business, BA300. You guys, I think it's a required course. You're going to end up taking it at some point to get more into this. I just want to touch on it now. So why don't we take a break, come back in a quarter of, and we'll dive into financial analysis.
I think we should reach out to them.
All right. So I'm going to jump a little bit out of chapter 1 in the ethics discussion to probably the most challenging piece of block of instruction, I guess, that we're going to have in this class, which is the time value of money piece, which is chapter 4 in your book. So time value of money is a critical concept. It's one that if you can get your head around this concept, you'll be able to get through the course in 90% of 75% of the math without a problem. If this hangs you up, it's one that we're going to have to work through. And a lot of your problems are going to be time value related. We're going to have to work through before we can keep moving. So I wanted to touch on this one tonight. There's ratio analysis, which if we have time, I'll get to as well. The ratio analysis is relatively straightforward. And if you look at the slides that are posted up on Moodle, you'll be able to kind of read through it, coupled with the book, it's going to be okay. Time value is a little bit more of a challenge. So we talked about time has a money value, money has a time value. So dollar amounts from different time periods should never be compared. Rather, the amount should be compared only when they are stated in dollars at the same point in time, such as December 31st of a particular year. Essentially, as you look at a time series or as you look at dollars over time, they need to be either inflated or discounted to a present value, to the value today or as of a certain date. Dollars from different time periods have opportunity to earn different amounts of interest. And so we're going to dig into how to calculate some of these things tonight. Here's a typical problem. At a 10% opportunity cost rate, which is better? Receiving, this is a typical finance problem, receiving $700 today or $935 in 3 years. You have 700 today. Anybody take the 935? How do you think you could back in the envelope this answer?
What's that? What did you say?
How do you think you can come up with a back of the envelope answer for this?
If I can make the difference before 3 years from 935 to 700, then I'll take the 700 now. But if I can't with my resources, then I'll go ahead and take 935 in 3 years.
Right. So here's how we can look at it. There's two ways, and you just described the first way. There's two ways to look at it. The first one is to go, okay, I've got $700 today. What can I get? What are my resources? So we're saying, well, I can earn 10% on it. So if I take $700 today and I go, okay, 700 times 700 times, or 700 times 10% times 10% times 10% compounded annually gives me a future value. FV is future value. Option B is basically saying, I got $935 3 years from now. Tell me how I can come back and get the present value. What's that worth to me today? So there's two ways to answer the question. One is, if I have 700 now at 10%, what's it worth? Or if I have $935 in the future, what's that worth today? Either one is going to get you the right answer, which is I either want $700 now and I'm going to invest it myself, or I'm going to take your 935 in 3 years. The way that the book uses these cash flow timelines, which is an easy way to visualize how this works. Essentially, you're going, okay, I got $700. I've got a rate of return of 10%. How much would I have here? 770. So if you then continue that process and you go 770, I've got a rate of return of 10%. How much would I have next? Close. You're probably going to compound. So you got 700 times 1.1 equals 770. And I've got 770 times 1.1 is going to be 770 plus 77 going to be 847. And I've got 847 times 1.1 equals 847 plus 8470. Oops. So which would you take? 935 in the future, because you're going to make an additional $3.30. Yeah, $3.30. So that's how present value, future value works. It's easy if it's a relatively short number of periods and a relatively easy set of numbers to just kind of visualize it this way and walk through it and go, okay. And I would recommend as you do some of the problems that if you start getting stuck, draw yourself out the timeline and just go, okay, what's my return in each period? You could do it out longhand like we just did together, and it's not going to be horribly difficult. You don't need massive, huge spreadsheets to do it. However, if you wanted to use a massive, huge spreadsheet to do it, we'll walk through that answer as well. So this is an Excel spreadsheet. There's a function in Excel, and you've got your functions, this formula tab, you've got functions and formulas in here. Most of what we're going to use in this class is under this financial section. So you can look at the financial section, and amazingly enough, when you roll down here, you'll see future value, you'll see present value. So if you say, okay, I want to know what the future value is, and Excel makes this easy. So you say, what's the rate? So on that last problem, what was the rate of interest? 10%. So you can either put 10% or 0.1. Number of periods? 3. Number of payments each period. How many additional payments were made? 0. So this is if you were making payments each period, but there's only one payment right at the beginning, right? So the present value, that would be the present value is 700. You see that down here at the bottom gives you $931.70. Now, Excel does some screwy stuff. It basically inverts the value, whether it's for net present value, for future value. So in this particular case, you go, okay, I'm using that formula. Use the Excel, use the little wizard that pops up there when you're doing the work, because it'll walk you through every step. You don't need to memorize even the formula. It's all in here. And it'll give you the 931.70. We calculated it by hand. If you had, and we can come up with a different example, and I'll show you how I build these spreadsheets, because this is kind of an important tool for you guys to use. But the formula is right there. So it gives it to you like that. And then you go, okay, do I want 935 or 931.70? Well, I'm going to take the 935. So that's the right answer. So if you got that question on a quiz, you'd go 935. If we said we've got $1,000 today, oops. It's going to be 22% the interest rate. And we're going to look at 24 years as the time. If I wanted to determine what the future value was, tell me what the rate is going to be. So the easiest way to start building these things is link them up. So C4, number of periods, 24. Number of additional payments? 0. Now, whenever you see these things that are in brackets, those are optional. So the present value, how much is that? 1,000. Type, end of period or beginning of period. One is an annuity due, the other is an annuity. We're not going to worry about that yet. So we're just going to close the brackets. $118,205.02. It's a miracle of compounding. Well, this is one of the reasons why when folks talk about, if you're 25 years old and you can invest in the stock market and get an average of 10 or 12% return every year, and you're going to have 40 years till you retire. If you invest, and this is why I link these, if you invest $5,000 a year, which you're allowed to in your IRA, and it returns 12% every year, and you've got 40 years to retirement because you're 25 years old, you'll have $465,254.85. A couple things to keep in mind when you're building these things out. It's far easier to both track your work and to keep track of all the numbers if you do this basic. You don't have to build a massive spreadsheet with all sorts of color coding and stuff, although I tended to do that over time. You build your own methodology, but it makes it easier, especially if I'm trying to grade it, but also if you're ever looking at it again 2 months, 3 months from now, you've done some analysis for somebody, you whip it out to do this basic, okay, let me link this stuff together. Because what might come back, especially because you're going to be a finance guy, is your boss will come back to you and go, so what would that be if it was over 35 years? And so you just go, okay, well, change that to 35, and that's the difference. So utilize these formulas in Excel, and it's going to make the math side of this thing that much easier. You can do it by hand. I'll prove it out that way. But this is the tool you guys should be using for this class. Makes your life a heck of a lot easier. So let's go back over to there's a couple of types of cash flow patterns, and we're going to learn how to do those cash flow patterns. Lump sums, single payment received or made that occurs either today or some date in the future. We just looked at kind of how to calculate that present value. An annuity is multiple payments of the same amount over equal time periods. So $400, you're going to get paid $400 a month for the next 22 years. What's that worth? So you'll be able to figure out, any of you guys retired military? You have any retired military in here? One. So we can figure out what your pension's worth by essentially going, okay, what's your payment per month for the remainder of your life, assuming you're going to live to 77 years old or 84 years old, and then you can present value that back, because we'll assume that it's not going to change. Your annuity is essentially an annuity. We can determine what the present value of that annuity is. So what's the value of that pension? And uneven cash flows. So you could have a situation where you're going, okay, I'm going to get $50 this month, I'm going to get $200 next month, I'm going to get $30 a month after that, I'm going to get $400 a month after that. What's the present value of that? What's the current value of that stream of cash flows? All we're doing is looking at what's the cash flow, what's the time, what's the risk. Which component of that analysis that we just looked at, so, I said, okay, here's 10%, $700, 10%. Which part do you think is compensating you for the risk? Which part's the cash flow? The $700 is your cash flow. The $931.70 is the cash flow. And the interest rate, or the rate, is what consumes the risk. So your risk is reflected in the rate, and the other part is the cash flow. The dollars are the cash flow, the interest rate's the risk. And that's how, if you kind of think about it that way, as we dive into each of these problems, think about the risk, think about the cash flow. The cash flow is always in terms of dollars, the risk is normally in terms of percent. And we'll analyze more how we come up with that. But you can calculate it for uneven cash flows. So future value, we basically calculated that right here. We said, okay, 700 times 10% times 10% times 10% gives me 931.70. This is the math. There's 4 ways to solve a time value of money problem. Cash flow timeline, use an equation, use a financial calculator, or the way that I hope that you will all do it in this class, which is use a spreadsheet, because the world uses spreadsheets. Now, if you want to use cash flow timelines and you want to do it manually because you're either somewhat morbidly ill and like to do math this way, or you don't have a computer, you can. And none of the problems we're going to get in this class are going to be so difficult that you could not do them with a basic calculator. However, I want to encourage every one of you to learn Excel. It is a skill that will continue to keep on giving long after you graduate here. And you're going to end up dealing with it anywhere you go. And so use the spreadsheet. If you have problems with the spreadsheet, like I said, hit the videos that I've loaded up. I'm also going to show you a couple free sources here online that you can get free lessons in Excel and continue to practice it. So here's some free and low-cost Excel tutorial options. This is all going to be up on Moodle, so you can take a look at it there. But these 3 have some pretty good Excel tutorials that you can kind of work your way through. Again, I would tell you if you get nothing else out of this class but learning how to use Excel and getting a little bit more comfortable and understanding these finance concepts and how they interact with your business, you're going to be successful here. So utilize some of these free and low cost Excel tutorials. Spend a little bit of extra time. Again, we're not in class as much as you would be otherwise. So take part of that 3 hours that you're saving by not having to come in on Wednesdays, put part of that toward Excel. Here early in the semester, you're going to find that it pays off massive dividends toward the end of the semester because you're going to have gotten comfortable enough that you'll just whip through the math problems. So we already looked at future value. Here's the equation version. So future value is equal to present value times 1 times the rate, or 1 plus the rate times, or to the n power, which is the number of periods. We're never going to use a financial calculator in here. This is your Bible. Microsoft Excel. There's a screenshot. So this is one that I had built for class last time. Get comfortable with the future value calculation, and then again, you can see that I kind of built this thing up.
So you have to put in the negative, so that way it won't turn out as red.
Yeah. Multiply by -1 or put it in as a negative for the present value. And the reason you put it in for present value as a negative is you're going, and this is the theory behind it, is you're going, I'm going to give you $700 today. So it's $700 out to get $931.70 back later. So it's minus $700 from my cash flow because I'm giving it to you now. And then I'm getting back $931.70. That's why it's a negative. Having said that, that's not necessarily intuitive to most of us. And so you can put it in as negative 700, or you multiply this by times -1. So future value of an annuity. An annuity is a series of payments of equal amounts at fixed intervals for a specified number of periods. An ordinary annuity, which is what you're going to run into most of the time, is an annuity whose payments occur at the end of each period. An annuity due is the payments that occur at the beginning of each period. So for most folks on a pension, you're paid on the first of the month for the prior month. However, on some government pensions, you're paid on the first of the month for the month. So if you're alive on the first of the month, you get to keep your money. If you die during the course of the month, they may take some of it back. Otherwise, the pension, if it's a typical annuity, a typical pension, It's paid on the first of the month for the month prior. So you retire, then you wait a month, then you get your first pension check, and then it kind of rolls from there. The simple way to think about how to calculate the present value or future value of an annuity is work backwards. So this is the future value of an annuity. What's $400 over 3 years at 5%? So you take the fifth year and go, okay, I'm going to get no interest on this. So I'm getting $400. 5 to the 0 power. Anything with 0 power is always 1. So I'm getting $400. This one, I'm going to get $400, but I'm going to invest it for 1 year at 5%. So I'm going to end up with $420. This, I'm getting $400. I'm going to invest it at 5% for 2 periods. 1, 2, $441. And I'm up, and you get $1,261. However, we can solve this with Excel as well. So let's go look at Excel. We're going to change this to payment, $400. So today, the present value is 0. 5% interest rate, 3 years, $400 payment. So the one thing we need to add it's just that easy. So Excel allows you to build this thing and calculate it like that. You don't need to memorize those formulas. You don't need to memorize exponents. You don't need to use Excel. It's right there. Any questions on that piece? The only difference between an annuity and an annuity due is, like I said, the annuity due is paid at the beginning. So it's paid at the beginning of the period, not the end of the period for the period prior. So you essentially get one extra period worth of interest. So it's a little bit bigger. That's it. When you go back to Excel, if you remember this formula, there was the you look at this formula, there was, if you get in here, recall it said annuity due. 1 is at the beginning of the period, which is an annuity due, 0 at the end of the period. So we highlight C7. Just that easy. You'll get a ton of these kind of questions. If you get in Excel and just kind of work it, use the formula wizards up here. It makes it that much easier.
So that was the last part of the estimate.
Yes. Yep. And you can see that 2 different ways. One, when you go in here, if you click in the, if you click in the formula, you'll see that it'll give you the components: rate, number of periods, payment, the present value, and then the type, and that's going to be your annuity due or not. The other way to get it is if you use the formula wizard up here and you use future value, it pops up the dialog box, which is, from my perspective, even easier to use. And it'll tell you, it gives you the definition right there. So if you go down to type, and it'll do this for every formula that we have in this course. So utilize the tools at your disposal. Cash flow streams. So payment designates constant cash flows, an annuity stream. Cash flow designates cash flows in general, both constant cash flows and uneven cash flows. This is for the book. What you're going to find in Excel is that it doesn't really care if it's uneven or even. The math for Excel is the same. And I'll show you how to build this thing out, but it's not that hard. Again, you're going to look at the math here and go, holy crap. And then you'll get into Excel and it's relatively straightforward. You just need to understand the concept. So if you have uneven cash flows, essentially you take each period and you discount it separately and come back. So in this particular case, the future value of an uneven stream of cash flow is 400 in period 1 and 300 in period 2 and 250 in period 3. You discount it back. Anything with 0 power is 1. So 250 times 1, 300 times 1.05, 400 times 1.05 to the second power comes up to 1006. But we can do things easier. So if we say we've got 400, the 400, 300, 250, 300 and 250. So that's my cash flows. And then I want 5%, 3 periods. Today, present value annuity due is 0. Oops. Actually, I'm gonna build this differently. Let me come back to this one because I'm having formula problems on the fly. Man, how embarrassing can it get? Periodic constant payments. Oh, where's my annuity ones? Catch me on a bad day. I will come back to this. I'm going to actually post it out to you because there's a formula and I'm not finding it. So I'm going to hit present value now, and I'll come back to the future value because I just need to take a few minutes with my Excel friend here. So present value is the value today of a future set of cash flows or series of cash flows. And discounting is actually bringing it back to the current value. It's the reverse of compounding. So essentially what we're doing, if we take that original problem, we say, okay, we've got $935 as the future value. And which one would we prefer? You had two choices. You said, okay, I've got 700 now, and I can run it forward and try and see what the total future value was, which in this case was $931.70. Or I could take the future value of $935, which is what I get in 3 years, and discount it back, which is essentially going and taking the process and running it in reverse and saying, okay, divided by 1.1 is 850, divided by 1.1 is 772.73, divided by 1.1 is 702.48, which is higher, 702.48 or $700? 702.48. And so essentially what you're going to come up with is 702.48 is higher than 700. So you're going to say, okay, give me the 935 in the future. Same answer as you come up with doing this, which you're saying, okay, I have 935 in the future, or I have $700 now. If I reinvest that 700 on my own, I can get 931.70. And so as a result, I'm going to take the 935 in the future versus the $700 today. Again, this essentially has a very similar set of functions associated with it. This is what's called the discount factor. Back when I was a young lad, we had tables that we would look this up, like little flip cards, and we go, okay, what's the interest rate? How many periods? And you come up with a factor, 0.7513. You'd multiply the future value by that amount to discount it back to the present value, which is 702.48. Now we have Excel. So let's see if I can figure out Excel this time. Today's present value you want present value. So let me pull it down here. So the rate in this particular case is 10%. Number of periods is 3. The payment that we would receive in the future is 935. Oops, excuse me, the future value is 935. So our present value is 702.48. It's because Excel's loving me. So again, the formula is going to get you to the right answer, even if sometimes it's a little bit painful to get there. I can build, and I'll end up building out the present value formula and future value formulas for the annuities. Any questions on how to get to this present value? It's essentially the same process as we did here with future value, but you're going backwards. So present value of a 3-year $400 annuity if R equals 5%. So if we're going back to this formula, essentially we're changing this to payments. Pull this down again. Present value of an annuity. So we're looking at $400 payments, 5%, 3 periods. And 89.30. So those formulas are really going to solve a lot of the problems. You may have to nest some of the formulas to build these up, but I'm quite certain that there's a formula that takes into the summation for the annuities with variable cash flows. But for ones without a variable cash flow, you can see it's straightforward as using the present value and future value function. So you can build it with these big equations, or you can use Excel. If you have an annuity due, you just add the 1 at the end of the formula, and it builds it into an annuity due, where again, the payment is done earlier, and so as a result, you've got an extra compounding of the interest. So now we'll talk a little bit about a perpetuity. Perpetuities, there's no real good Excel formula that says it's a perpetuity, but the math is really straightforward. And I'll show you what it looks like in both Excel and outside. A perpetuity is something that's expected to go on forever. So if I said I'm going to give you $100 a year or $100 a year forever at 10% interest or 10% opportunity cost, you can calculate that. And the reason you can calculate it is once you get out past, say, 75 years, how much is that $100 worth to you in 75 years? Nothing. Yeah, you might be dead, but it's probably worth nothing. So when you think about how present value works, the further something is out there, the present value of it gets smaller and smaller and smaller and smaller and smaller. So the value of $100 in 100 years is worth a lot less than $100 today. And so essentially what this math problem says is it eventually converges to 0. The value out in infinity is basically 0. So we can calculate the present value of a perpetuity by taking the payment that's being made. So if I said I'm going to give you $100 a year, by taking the payment that's being made and putting it over the interest rate, 10%. So the value of $100 a year in perpetuity at 10% is $1,000. You give me $1,000, I'll give you $100 a year for the rest of your life, for the rest of forever. And that's a perpetuity. So it's easy enough to calculate that's this example here. The top one is $100. If it's 5%, it's $2,000. So the present value of a perpetuity is really easy. It's just taking the payment amount, dividing it by the interest rate, period. Because as time goes on, those out values converge to 0. Here's present value of an uneven cash flow stream. I'm going to get in Excel because I'm not going to embarrass myself anymore by not having the formula ready. I'm going to get in Excel and send it to you, but it's essentially the same methodology, which is you take the 250, you discount it back. You take the 300, you discount it back. You take the 400, you discount it back. At the rate, each one of these comes back to a present value. So 400 times 1 over 1.05 to the first. So discount at 5%, 380.95, 272.11, 215.96. It adds up to 869.02. So if I said, I'll give you $400 in a year, $300 2 years from now, and $250 3 years from now, or I'll give you $869.02 today, you wouldn't theoretically care which answer you got. As long as this adequately represented what? What about the time? Yeah, so talk to me about, we got two components, right? You got cash flows, 400, 300, 250. What's the other component to analyzing this? Risk. So as long as the 5% is an adequate compensation for the risk you're taking for being 400, 300, 250, you don't care whether you get 400, 300, 250 a year, 2 years, 3 years from now, or 869.02 today. You're indifferent. If this was 870, you'd say, give me the money today. If this was 850, you'd say, give me the money over time, assuming that the risk represented by this 5% is accurate. And we're going to talk, and you're going to pick up over time risk. It's this concept called capital asset pricing model and risk-free rates and risk premiums. We'll talk about that. But as long as that 5% is right, based upon what you think the risk is, then you're indifferent as to whether you take the cash today or whether you take this amount of cash today or whether you take that cash flow over time. Any questions on the concept of present value? Or future value? Very briefly, present value and future value. Present value is what the money is worth today. It doesn't contain interest. It might be discounted at the interest rate that you'd expect, but it doesn't contain interest. That value is the money today. Future value contains interest. It contains the compensation, that interest amount, that risk premium that you're getting for having the money out over time. So if you look at the project or the problem we've been working, the lump sum payment today has no interest. It's the same as a lump sum payment of $931.70 in 3 years, assuming a 10% interest rate. So you'd be indifferent to take $700 today or $931.70 in 3 years. The $700 today has no interest. It's $700 today. The $931.70 has $231.70 of interest. That's your compensation for taking the risk. That's your time value of money. That $231.70 is paying you for having that money out, for taking the risk over that time. And this just shows that graphically. You'll notice that that interest rate compounds as well. Normally in finance, we focus on compound interest, not simple interest. So it's not 70, 70, 70. It's 70, 77, and then 84, 70 because we're compounding the interest because we're keeping that money held out. We're not getting the interest paid to us, right? We're not getting it paid to us until the third period. And so we should get compensated for not getting paid on that interest as well. If they were paying the interest every period, the cash flow would be $70, $70, $70, and then you would have essentially the present value of those $70 factored in. So you can also use Excel to solve for interest rates. So suppose you pay $78.35 for an investment that promises to pay you $100 5 years from today. What's the annual rate of return you'll earn on your investment? So let's go back to that one and let's walk through it. Hopefully I don't hose this one up. So the future value is 100. How many years? 5 years. Present value is 78.35. Future value is 100. What's the rate? It's number of periods, 5. Payment is 0. Present value, 78. Future value, 100. What's the interest rate? 5%. So to solve for these types of problems, you're going to use the equals rate. And again, that's found here in the financial section. And that'll give you the answer. There's a couple other ways to solve it using goal seek, but the at rate will work extremely well. So the next one says a security that costs $68.30 will provide a return of 10% per year. If you want to keep the investment until it grows to a value of $100, how long will you have to keep it? So now we're looking for the number of periods. So what we've got for solving this, present value is negative 68.30. Interest rate is 10%. The time period is unknown. So that's our solve for X. Oops. There's no payments, no annuity due, future value of $100. So we go to number of periods. The rate, 10%. Payment is nothing. Present value, negative 68. Future value, 100. Number of periods equals, oops, 4. So to solve for these, use NPER, number of periods, and it'll give you the answer. Again, Excel does a nice job of saving us a ton of time trying to solve for this stuff. You can do it by hand, essentially going, okay, let's multiply that and figure out if I multiply this 6810 by 10% times 10% times 10% times 10%, when do I get to 100? And you can do it that way, but it's far easier to use the formulas in Excel. Yes, ma'am.
It's not directly related to the slides, but
Okay.
it's related towards our online work. I see there's like a first week online assignment and chapter 3 and 4 online assignment. Where would we find those? I see in the grade book, but I don't.
Let me show you. Oops. So when you go to the assignments piece, you'll see that there's a calendar in there.
Yeah.
And if you click on quiz chapter 1 through 4,
Yeah.
it'll then pop up the quiz
Yeah.
for you to take.
Okay.
And it's the same thing if you guys are like, you know, hanging out in Starbucks and you don't have your book or whatever, and you're like, you know, I just want to sit down and study a little bit of this. What we're going to try and cover for the class is going to be right here. So you'll have the chapters that we're covering in the, so you should be able to access it there. And then
Yeah,
it'll,
I've done the quiz for the first week already.
Okay.
Last week, and I read through everything, but what I don't understand is, not from the assignments page, but from the grade book.
okay.
It's your chapter 3 and 4 online assignment.
Yeah, and I don't know how to access that.
This is chapter 3 and 4.
First chapter.
I can show you my views. But yeah, that's one of them, the chapter 3 one, and the first one.
13 assignments. Oh, it shouldn't have 13 assignments. Interesting. Okay. Let me dig into that. That's a great, no, that's a great, no, that's a great question, because there should only be the 4 or 5 quizzes, which
And
are,
I can access all those.
okay.
Yeah.
Because yeah, that should be it. I mean, there shouldn't be anything else.
I wasn't sure if it was like the readings and it goes from blue to like pink, I think, or something when you cover the section.
Yeah, no, I'll dig into that, because that does not make sense, at least as I set it up. Now, the issue, I think, and it's probably something on how I've got it set, because Lacey, I teach the same class at Lacey, it's 15 weeks, and they have 15 quizzes, and it may have imported over some of those quizzes when I was setting the classes up, but don't worry about it. You're only getting
Just worry
graded on
about
the,
the quiz.
yeah, just worry about the ones that are sitting there. Any other questions on that before we shift back into this stuff? Because again, it's going to kind of come hot and heavy. The other thing that you'll notice is the quiz is due next Monday. So bring your questions to class. It's not going to be due until midnight. Essentially, it'll be Tuesday. I'll probably ship them all to Tuesday. So that way, if you have questions, as you've been doing the quizzes, and you go, crap, I don't understand how to do this, that, or the other thing, that's what I want to be able to cover in class, and then give you time to go back and go, okay, now that I've got it, I'm going to redo those couple questions that I didn't get. So I'll probably shift everything to Tuesday when I'm cleaning up what you just pointed out, Maria, and we'll be squared away. So the quizzes aren't due until after class, and you bring your questions in and we go through them together. So again, the intention is to get you to learn this stuff, not to figure out if you can memorize things. So you're in college now. I don't need to worry about whether you can memorize. So when we're talking about other periods, other than annual, so what we've been using is essentially an annualized period. When we're looking at periods other than annual, divide everything. So if it's 12% interest, compounded monthly, your interest rate is going to be 1%, and you're going to have 12 periods. If it's semi-annual, it would be 6%, you've got 2 periods. If it's quarterly, it would be 3%, you'd have 4 periods. And so essentially it's how quickly you compound. Each one of those turns or each one of those compounds results in additional interest accruing on the compounded amount. And so if you've got a question and it says, it's a 12% interest compounded quarterly, you're going to divide the interest rate for 3 years, you're going to divide the interest rate by 4, you're going to divide and multiply the number of periods by 4, and that's going to get you your math result. Normally that compounding, unless you're going out for a lot of periods, that compounding, if you did it annually, if you did it quarterly, if you did it monthly, it's not going to make huge differences in your present values or your future values. However, some of the questions you're going to see on the tests or the quizzes are going to make it, they're going to be close enough that you're actually going to have to calculate it out. So just make the division and multiplication and you'll be okay. Future value of a lump sum can be larger if interest is compounded more often, holding the stated R or rate constant. Why? We just talked through it. Compared to annual compounding, a greater amount of interest is earned when interest is compounded more than once a year. So if you compound monthly, it goes up by 1%, 1%, 1%, 1%. That 1% that it went up by is compounded, so it goes up by 1.01% the next time, 1.011% the next time. So you're able to grow it that much quicker. It's not going to make a huge difference, but it's going to be something that you should be aware of. So simple interest rate is a quoted interest rate. Annual percentage rate, for our purposes, is the same as the simple interest rate. The effective interest rate is the annual rate of interest actually being earned, and we'll walk through what that means. Here's a couple examples. So what I was talking about, if you got 8% compounded quarterly, divide that by 8% by 4, you get the 2%. 8% compounded monthly, you divide the 8% divided by 12, that gives you 0.667% interest. You're going to run into this periodically, no pun intended, in the quizzes. Keep your eyes open. Whenever you see compounded in the call of the question, whenever you see anything other than annually, so when you see things like monthly, quarterly, your antenna should go up and go, okay, this might not be just plug 12% and 3 years in. So be on the lookout in questions for things like compounded, because normally it will, if it's compounded other than annually, if it's compounded annually, half the time they don't put compounded, or they don't say it's compounded annually, it's assumed. Look for compounded, look for periods of time shorter than or different than annual. The effective annual rate essentially takes the effect of that compounding and reduces it back to a simple interest rate. So it's relatively straightforward to calculate. In this particular case, if we've got 12% interest being compounded over 12 months, you end up with an effective interest rate of 12.68%, not 12%, because it compounds that little bit of interest on top of itself every month. Everybody follow that? Essentially, if you took the future value of $1,000 at 12% for 1 year, you'd have how much? $1,000 at 12%. How much interest would you get if it was simple? $120, right? If it was compounded monthly, how much interest would you have? Using the data that's up here. So, yeah, $126.80. So if you have $1,000 at 12% compounded annually, at the end of the first year, you're going to have $120 of interest. If you have $1,000 at 12% compounded monthly, you're going to have $126.80. So you can see it's a little bit different. It's not a huge number, but that more rapid compounding, even though it's the same stated rate at 12%, results in an effective annual rate of return of 12.68%. So again, just keep that in mind. You'll get a couple questions on it. The easiest way I tend to think about it is go, if it was $1,000, what's the difference? And I put $1,000 in, and I go, okay, give me $1,000 compounded annually, give me $1,000 compounded monthly. So you divide by 12 and do it monthly, and you go, okay, it's 126.80. So the effective annual rate is 12.68%. It's the same thing when you buy a car. When you're doing your loan documents, and it'll say your annual percentage rate is 8%, your effective annual rate is 8.68%. And it'll put it right on your loan documents. And it'll say, and you'll pay this much in interest over the life of the loan for your car. That's really to give you a disclosure that what they said was 8%, really you're paying more than that because it's compounding monthly. It's not compounding annually. It's got an annual percentage rate, but it's compounding differently. An amortized loan is a loan that's repaid in equal payments over the portion of its life. And as you get into Excel, I'm trying to think how to cover this in the last couple minutes we've got. An amortization, and we'll build an amortization table probably next week together. I think that's probably a good way to dive into this thing, is build one in Excel. But essentially what you've got is, how do I get, if this is a 3-year loan and I've got an interest rate, how do I get from $33,000 to 0 in 3 years? What do my payments need to be? Well, it's in a typical non-commercial loan, you're not going to pay $11,000 because that's not going to pay your interest off. And you can see the interest amount that's being charged is being charged on the remaining balance. Column 1 times 6.5%. And so you've got to determine, and Excel can do it for you, and we'll walk through it next week, how to design an amortization table so that it zeroes out. You use goal seek and you use a payment function. But essentially what you're doing, this amortization schedule, is how most loans are paid. It helps determine what your payment amount is going to be, what your cash flow is going to be, out or in. Some commercial loans aren't calculated this way. They do calculate 11,000, 11,000, 11,000, and then it looks at the interest rate. So it'll say, 1245 or $2,145. So it's going to be $13,145. And the next one's going to be 11,000 plus the interest rate over here. And this is, instead of 22,000, or 22,685, is going to be 22,000. And so it actually is a level principal payment with a variable interest rate payment, and your payments decrease as you go through. That's far more typical on a commercial loan. You tend not to see that on personal loans. And for the purposes of this class, we ain't going to calculate those. But I want to point it out because you may end up outside this class in the real world, and you're going to find commercial loans tend to have, a good portion of them will tend to have a flat principal repayment because they'll have an interest rate that changes over time. They're going to be variable interest rates. I know it's a lot coming at you in a relatively short period of time. This present value concept is kind of the critical concept for, if you think about, again, when we talked about finance, it's a combination of cash flow plus risk. And combining those two things together to come up with values. The value of a stock, the value of a bond, the value of a project, and comparing the two. The fundamental calculation underlying that value of stock, value of a bond, value of a project is this calculation: present value, future value. And looking at cash flow streams, okay, what's the value of that cash flow stream today? And then the second piece is analyzing the risk and making sure that you're being compensated adequately for that risk over time. If you could get this concept down, this present value, future value concept down, and the math behind it, and the formulas behind it, the rest of the class is going to be relatively straightforward. If you struggle with this piece, then the rest of the class is going to be a struggle because we're going to build off of this. So So I want to make sure that tonight we spent enough time on it to at least give you some exposure in class. Likely, next class, depending on what you guys come back with for questions, we'll be walking through, my intention is to walk through a number of, absent a bunch of questions, to walk through a number of these examples, do them together, make sure that you're comfortable with the various formulas in Excel that we're going to need to be able to build on the rest of the course. The one we didn't cover, there's two chapters I didn't touch on today. There's chapter 2, which is ratio analysis. The math there is really straightforward. That's where we talk stories. And depending on how next week goes, we may touch on that a little bit. And the third chapter I didn't talk about, which is really money banking, financial institutions, and markets. Not a lot of, that's one that you guys should be able to pick up just in reading without it being the difficult progressive concepts. But if you're getting into it, you start running problems, bring those questions in next week. Anything else I can do for you all outside of a reminder, send your questions to me as you get them, and I'll post them through Google. And I'm going to get you guys the formulas that I somehow have not managed to remember for Excel for the I need to actually learn present value and future value. All right, let's have fun this semester. Thanks for everything.